Have you ever wondered how commercial property values are faring in today's market? Well, you're in for a treat. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Commercial real estate values in the United Kingdom saw marginal growth in the second quarter of 2025, according to new analysis from Altus Group, which tracks valuation trends across major European markets. The firm's latest pan-European dataset, covering 29 billion euros in assets across 17 countries, found that United Kingdom office values rose by 0.8% in Q2, outperforming the European average of 0.3%. This increase was attributed to favorable yields and continued rental growth, which supported investor confidence. Year on year, United Kingdom office values remained flat, while Germany and the Netherlands recorded declines of 0.6% and 1.5% respectively. France saw a 6.8% annual increase in office values. Despite the recent uptick, the office sector remains under pressure. Over the past 3 years, United Kingdom office values have fallen by 7%, reflecting the sector's ongoing challenges. Across Europe, office values declined by 7.7% year over year, placing the sector at the bottom of the rankings. Separate data from the Royal Institution of Chartered Surveyors also showed a United Kingdom commercial property market that remained largely flat in the second quarter. London's office sector showed more resilience than other United Kingdom regions, but overall occupier demand and investment inquiries stayed steady, with landlords offering incentives amid rising vacancies. For mortgage brokers, particularly those from Real Approved, these conditions highlight a market in transition. Opportunities are likely to be found in prime assets and alternative sectors, while most segments remain subdued. Brokers may need to tailor solutions as the gap widens between prime and secondary markets. Meanwhile, Altus Group's quarterly review also showed that, for the fourth consecutive quarter, commercial property values across its pan-European dataset increased, rising 0.6% from the previous quarter and 2.8% compared to the second quarter of 2024. However, the pace of growth slowed as cash flow gains moderated to 0.5%, the lowest level in a year. By sector, residential property led performance in Q2, with values up 0.9% over the previous quarter, supported by robust cash flow fundamentals. Industrial assets followed, rising 0.8%, although cash flow appreciation slowed. Office and retail sectors both posted modest gains of 0.3%. The retail sector continued to face weak rental growth and higher operating costs, which weighed on cash flow. Outside the main sectors, student accommodation values increased by 1.9% quarter on quarter. The return to office trend in New York City is not just a headline. It's a reality that is reshaping the commercial real estate landscape. According to the Placer.ai Office Index, more employees are now working in New York City offices than in July of 2019. The platform, which uses cell phone data to track foot traffic at commercial buildings nationwide, found a 1.3% increase in staff presence at Manhattan desks compared to pre-pandemic levels. This data challenges the narrative that hybrid work has significantly impacted commercial real estate, an industry critical to the city's economy and tax revenue. The notion of deserted office buildings is being dispelled by this new data, which suggests that the work-from-home era in New York City is largely over. JLL, a leading real estate brokerage, supports this view, stating that the city's office market is on the rebound. While other major U.S. cities like Los Angeles and Chicago still lag behind their 2019 office use levels, New York City is seeing a revival, with office vacancy rates dropping to around 16%, the lowest since 2019, and reaching near zero in prime locations. This resurgence is not just about the numbers, it's also reflected in the behavior of major companies. Firms such as Amazon, Goodwin Procter, and Sumitomo Mitsui Banking Corporation are leasing significant office space, demonstrating confidence in the city's commercial real estate market. Even new developments are underway, with BXP constructing a new tower on Madison Avenue, despite having only 30% of its space pre-leased. The return to office movement is also benefiting other sectors, notably the fast casual dining industry in Midtown and downtown Manhattan. Eateries like Sweetgreen, Pret a Manger, and Joe and the Juice are capitalizing on the influx of workers returning to the office, signing leases for previously vacant retail spaces. This trend underscores the broader economic recovery underway as New York City continues to navigate post-pandemic realities. However, the narrative of the return-to-office trend is not universally accepted. Some media outlets continue to emphasize home-based work, often citing data from sources like Castle Systems, which may not fully capture the current office occupancy dynamics. Castle's data, for example, monitors card swipes at buildings where it provides services, which may not be representative of the entire market, particularly high-occupancy, premium office spaces. The discussion around office occupancy often misses the nuance that pre-pandemic offices were not 100% filled on any given day. The Partnership for New York City's recent estimate of 57% office attendance, for example, actually represents 76% of pre-pandemic attendance levels. This suggests that the return-to-office trend is robust, even if not all surveys align on the exact figures. Swift Real Estate Partners has completed the sale of a 146,000 square foot office building located at 790 East Colorado Boulevard in Pasadena, California. The asset was purchased by GD Realty's Arash Dani Alifar in an off-market transaction facilitated by Barak Investors Group. The sale was represented by JLL, who also represented Swift when they acquired the building 6 years ago as part of a $193 million United States dollars portfolio transaction. This office building, which was completed in 1981, is LEED Gold certified and recently underwent renovations. It features amenities such as a fitness center, a full-service kitchen, outdoor terraces, and a conference facility equipped with a boardroom. At the time of the sale, the building was 70% leased. The property is strategically located just 1 mile from the city center, in proximity to major dining and shopping venues. It is approximately 11 miles from downtown Los Angeles and 28 miles from Los Angeles International Airport. The JLL Capital Markets Investment Sales and Advisory Team, led by Managing Director Andrew Harper, Senior Managing Director Jeff Bramson, Senior Director Will Polson, and Associate Jacob Malloy, facilitated the transaction. Jeremy Wustman, Swift's investment manager, led the sale proceedings, while Omid Braucom of Barak Investors Group negotiated on behalf of the buyer. The Los Angeles office market continues to show strong performance, according to Yardi research data. As of May, Los Angeles was ranked as the second top-performing metropolitan area in the United States for office transactions, with an average price per square foot of $281 United States dollars. San Francisco followed closely with $272 United States dollars per square foot. In one of the largest sales of the summer, Barings paid $150.7 million United States dollars for a creative office campus in West Los Angeles, which was sold by Clarion Partners and spans 306,809 square feet. Additionally, Sunny Hills Management Company purchased a 462,000 square foot office campus in Culver City, California, with Newmark brokering the deal. The Meitinger Tower, located at 462 South 4th Street in Louisville, is currently on the market as it undergoes foreclosure proceedings. This downtown office tower, one of the tallest in Louisville, has faced financial difficulties following a default on its $28 million United States dollars loan in late 2023. The situation led to a foreclosure lawsuit in June 2024, resulting in a court-ordered receiver taking control of the building, according to reports from the Courier-Journal. The sale of the Meitinger Tower comes at a time when the Louisville office market is experiencing significant shifts. As the tower is under foreclosure, it presents a potential opportunity for investors to acquire a prominent piece of real estate at a potentially reduced price. This scenario reflects broader trends in the commercial real estate sector, where distressed properties can offer attractive investment opportunities. In the context of the Canadian market, particularly in regions like Kitchener-Waterloo, London, and Cambridge, Ontario, similar trends can be observed. These areas have also seen fluctuations in office space demand and valuations, influenced by factors such as the return-to-office movement and evolving tenant needs. However, the Canadian market has shown resilience, with some areas experiencing a rebound in office leasing activity, suggesting a stabilization in certain segments. Comparatively, the American office market, as exemplified by the situation in Louisville, presents a varied landscape where foreclosure and distressed sales are more prevalent. This cross-border perspective highlights the differing economic conditions and market dynamics between Canada and the United States, offering insights into potential investment strategies for those looking to diversify their portfolios across regions. This week, significant commercial real estate transactions were recorded across several counties in Florida, as reported by Stephen Benna. The transactions, each exceeding $1 million United States dollars, highlight a diverse range of real estate assets changing hands. In Charlotte County, Dreamfinders Homes Limited Liability Company purchased vacant land in Punta Gorda from Burnt Store Developers Limited Liability Company for $2,060,000 United States dollars. Additionally, the School Board of Charlotte County acquired vacant industrial land in Port Charlotte from iPark ACC Limited Liability Company for $1,800,000 United States dollars. Over in Collier County, one of the most notable transactions involved 2,277 Arbor Walk Circle Limited Liability Company acquiring multifamily units from Oasis, Naples Apartments Limited Liability Company for $40,920,000 United States dollars. This transaction underscores the demand for multifamily properties in the region. In Hillsborough County, IOS Hemlock Titleholder Limited Liability Company purchased a storage facility in Tampa from Port Hendry Limited Liability Company for $37,800,000 United States dollars. The demand for storage facilities continues to rise as businesses and individuals seek additional space solutions. Lee County saw Coral Harbor Equity Apartments Limited Liability Company buying multifamily units in Fort Myers from Season Family Limited Liability Company for $9,500,000 United States dollars. This transaction is indicative of the ongoing interest in multifamily investments across the county. In Manatee County, the transaction of note was Manatee County purchasing vacant land on Golf Course Road in Parrish for $9,500,000 United States dollars. The acquisition represents the county's investment in future development opportunities. Pasco County reported a significant transaction with Cerium Sun Lake owner Limited Liability Company buying vacant commercial land in Land O'Lakes for $12,500,000 United States dollars. This purchase suggests potential commercial development in the area. Pinellas County was highlighted by the Pinellas Housing Authority's acquisition of apartment units in St. Petersburg from Portland Property Limited Liability Company for $8 million United States dollars. This transaction reflects the ongoing need for housing solutions in urban areas. In Polk County, Prime Storage Davenport Limited Liability Company purchased a warehouse in Davenport from Blackfin Champions Limited Liability Company for $9,500,000 United States dollars. This sale emphasizes the growing demand for industrial spaces. Finally, in Sarasota County, 5 Point Equity Limited Liability Company bought a retail strip store on South Tamiami Trail for $7 million United States dollars, representing a strategic investment in the local retail sector. These transactions illustrate the dynamic nature of the commercial real estate market in Florida, with investments spanning multifamily units, industrial land, and retail spaces. As the market continues to evolve, opportunities for investors remain abundant. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.